Hello, everybody. Welcome to In the Matrix. I am your host for the show. My name is Tanya Woods Richardson, and the intention and the purpose of this program, as always, is to give you access to the experts and their insights and perspectives that help us better navigate the realms of money management, money mindset, and money motive. Because it's when these three worlds come together that we are once and finally forever able to master our money. And today I am so excited to have with us Laurie Renton and Rob McDill to talk to us about the fun and sexy topic of life insurance. We're having a good chuckle about it because a lot of people might not describe life insurance in that light. But for many of you who have been through the matrix, this is what I have noticed, I've observed that has come up over and over again. We see life insurance as one of those little lines right up there as an expense. And most of you are just putting in, well, you know, it's $50, $100, whatever that may be. And most of us don't know where that money is going and to what end, for what benefit, and you know how that really serves us in the end. The other area that we're going to ask Rob and Laurie about a little bit today is the cash surrender value that we oftentimes see when we start looking at net profit. Remember, under our assets, we see this cash surrender value under life insurance. And this is where I usually get a lot of hands going, what the heck is that? So we're going to talk about that, but so many other things today. This is going to be such an eye-opener, and I am so excited to get started on this. I'm so looking forward to learning so much. So a little bit about our guest today. So Laurie and I had the opportunity to connect. It was probably about 2 years, maybe 3 years. It goes fast. Maybe it's even 4 years ago. Oh, yikes. But I was in Yorkton doing a presentation on planning for profit, right, for business. And Laurie was there as a board member for Community Futures. Laurie is brilliant. She is the founder and operator of LR Futures out in Yorkton. And one of the things, I love many things about Laurie, but lifelong learner. And one of the things that you'll notice in our call today is she takes a very integrated approach to financial health and wellness, including the understanding and appreciating the Enneagram philosophy. Is that right, Laurie?
Yeah.
And this is, it's about money types a little bit, right? Like understanding your personality and maybe why you do some of the things you do and maybe why we don't do some of the things we need to do. But so excited to have you here. Thank you. And just for everybody on the call as well, Laurie is familiar with the matrix, and so she might be able to speak to her experience in life insurance and kind of be able to tap into what your mindset may be as it comes to that week one experience. And then Rob McDill, Laurie kindly introduced me to Rob, I think it was 2 months ago. COVID had just hit and reached out to you in a very different capacity. And I could have stayed on the phone with Rob for 45 minutes. Just the conversation, it was brilliant. So 30 years in life insurance, right, Rob? CFP, which is, what's that?
Way to age me.
It's wisdom. It's wisdom. They're assets. Assets. Yeah. So CFP, Certified Financial Planner, and CLU, Chartered Life Underwriter. Do I have those correct?
Right.
And what I find really fascinating about your practice right now is that your parent company is out of Winnipeg. It's PPI.
Yes.
And then you represent 17 different insurance companies. So it's not necessarily one, right. You get to reach out to many. So yep. Again, you know, just integrated, making sure you can do what's in the best interest of the client is my guess, my assumption of why you do that. And then I have to tell you, I fell in love with Rob because when we were talking about integration, it's for many of you that know me, and when we're in here in the matrix, we're always talking about how you need to build your A-team, how you have an accountant, a planner, the advisor, your lawyer, right? All of these people coming together, especially with your estate and for the entrepreneurs, how all these people are working in your best interest. And then Rob was like, you know, all these people need to be speaking to one another. They need to be at the table together, ideally with one another, understanding what's in your best interest and that of your financial future. So excited to be here with both of you today. Thank you so much for sharing your time and your expertise with Canadian entrepreneurs across the country. So let's jump in. Life insurance. Actually, before we jump into life insurance, maybe there's many different types of insurance, right? I think a lot of us are familiar with, okay, we've got the automobile insurance, we've got property insurance. Those are usually easy for us to look into, buy into for our homes and our businesses. And then there's all the insurance that gets attached to us as human beings, whether it's the life, the critical illness, the disability. What am I missing? What other types of insurance? Sorry, what's that? Long-term care. Okay. What else is in there? All different. Okay. And so when we talk about life insurance, does that mean we're talking about all of those areas, or is that just one area specifically?
Yes, yeah. When you're talking about life insurance, the other one we didn't talk about was group insurance, which a lot of folks have through their employers, or if you're an entrepreneur, you may be buying it for yourself, group insurance for yourself, or for your employees as well.
Okay.
But the one thing I saw that your title here was life insurance: how to buy peace of mind, and oftentimes we rent peace of mind, and so that's another way to look at your life insurance. We'll talk about that in a minute.
Oh, I love that. Okay, so can you elaborate on that a little bit? So
well,
we're not
the one thing you asked me was about, the different types of life insurance.
Yeah.
And to keep it simple, like I really want to keep it simple because we could drill down and get very complicated in a lot of areas. But the one thing that oftentimes when I'm dealing with clients, the budgets are involved, and so you're looking at term insurance. And term insurance is exactly what the title says. It's for a term. Oftentimes businesses will buy it for, or we'll have term insurance to cover a business loan. Oftentimes, you might have a 10-year term loan because that's the term of your loan on your business. Or people might buy term insurance or rent term insurance because it's much less expensive off the hop. The problem with it is that it gets more expensive as you go along. So you keep, the older you get, the higher that mortality line gets, the more expensive your insurance becomes. When you're buying your insurance, if you're using a product like a whole life or sometimes you hear called permanent insurance, you're basically paying more upfront, but you're building equity in your insurance, and it may be paid off in, say, 20 years or however you choose to set up your policy, again, without getting into too much detail. And oftentimes there's accounts that will help you by putting dividends into your account as well. Again, I don't want to get too complicated, but that's part of whole life or permanent insurance.
Okay. Cash flow, right, Tanya?
When
it comes to like, how much is this going to cost me? I think that's people's biggest thing is, how expensive is it going to be? So what I've seen people do, because I do a planning session and it takes me to 9 domains around money. And when I get to number 6 with clients, it gets me to risk management. How well do you anticipate problems in your life to stay on track? So that's where the word insurance comes into play big time. So people often insure their homes and their cars because they have to, they're forced to, before they even insure the most important thing is their lives. But what I have seen with working with clients through this process is they're a young family, let's say, they buy life insurance at the time. So they buy term, which is what Rob just spoke about. So it's cheaper, but all of a sudden 10 years go by and then the price just goes, whoo. So really pay attention when you're looking at those different types of insurance. Yeah, it's going to be a little more upfront, but it's going to protect you for that long period of time. So be okay to be okay with that.
So it kind of reminds me a little bit of mortgage shopping, right? Where you can get the fixed or the variable and hedging those bets. But right off the top, you've completely kind of turned everything around for me, because for me, the expectation was what happens when it's being paid out. So I thought term was about when it's being paid out, it's for a specific term, and whole was for the duration of whoever it is that's up behind. So it's actually your payment up front that is the term, and then whether it's whole life, so you're paying into it.
An example. Let's just keep it simple. Let's say you have a young couple and they've got one child, and we've sat down and we've established that they need $500,000 of life insurance. So then we look at it and we go, well, the term is going to cost you, Mr. or Mrs., it's going to cost you $25 a month or $50 a month to get this 10-year term insurance, which is, they're like, okay, we can easily afford that. That's fine. We'll take that. Well, in 10 years, what happens is you're 10 years older, okay? And you've been pulled into a group of a bunch of people that are also 10 years older, and some of them are unhealthier. So your premium then automatically renews and then goes up. And then it stays permanent for another 10 years. And then it automatically renews and it goes up. Well, those jumps, it's not like a nice, easy set of stairs. It's like the Nitol commercial where you're looking up and the stairs get higher and higher and higher. And that's what happens with your term insurance. Okay.
Gotcha.
With your permanent insurance, what you're doing is you're establishing that this is what I want to do. I want to create some value in and there's no value at the end of that term insurance policy. There's none. So for example, I had a business owner call me the other day, and they were doing a net worth statement, and they were looking for their cash surrender value, as you talked about earlier. There wasn't any in her plan because she has a term insurance policy that she bought from another advisor. So when I looked it up, I go, there is no value in this. It's only valuable if you pass away.
There is no value in term insurance.
There's no equity, there's no value in it. But it's typically significantly lower premium. Business owners like it because the premiums are low. We can talk about how to write off the premium for a business owner, and it only covers for that term. It only covers, so you want, you're building, you're borrowing, you're trying to establish your business, you need to have it covered. So the term insurance would be a good option for you.
Okay.
And that's typically what we use in that scenario. When we have mature businesses, we look at a completely different life insurance structure for them.
Okay. So life insurance, so we've got term, we've got whole life. That's how you're paying into it in the early days. So it seems off the top of my head, it would make sense. It kind of reminds me of compound interest, where the younger you get into it, right, the more advantages. Is that the same with life insurance? Because less health risk?
Absolutely. Because if you're buying term whole life or permanent insurance at a younger age, okay? I always love this question. Should I buy insurance? Like, what are the insurance companies? Would they rather insure younger people or older people? And the answer is both. But they charge the hell out of the older people.
Right. Okay.
Does that make sense? Because they're going to die more often.
Absolutely.
Out of the cohort group, right?
Health
so
issues.
The younger you're buying it, the less expensive it is. But the best way to compare the difference between those two policies is renting an apartment, buying a house.
Okay.
And your rent keeps going up.
Right. Absolutely.
That's the best analogy.
I think, like Laurie said too, it's, what I've noticed with property as an asset, sometimes the appreciation value and taxes and everything, you don't always, it's kind of a wash, but it's forced, right? It's forced. So people make that payment. They don't, like it's priority number one.
Well, when you're sitting down with clients, it really becomes in that particular case, it becomes a matter of budget. How many things can you cover? Can you cover the RSP, the educations, the all the different insurances, the taxes, everything that you have to take care of, and your insurance? And oftentimes that budget is the last one to be looked at. That portion of your budget, and so that becomes an issue.
So I think that kind of comes back to what Laurie talked about, where it's not seen as a priority because right now our health is okay, but insurance is always about hedging those bets, right? About the unforeseen and not even what we anticipate coming up for us, what possibly, we don't anticipate.
Most things you need one thing to buy things, and that's money. With life insurance, you need two things. You need money and health.
So this was a question that came in actually from Michelle about health-wise and insurance. How does that work? So I'm not exactly sure if she's referring to if you're not healthy, can you get insurance? But if you have any sort of family history of cancer, do all of these things impact your rate that you're going to receive?
Life insurance question. When you're going through a life insurance application, family history is not as important as it is for critical illness insurance. Okay, like critical illness insurance is a lot more like what's going on? Like, did you have a mother, father, brother, sister with? Now those questions are asked in the life insurance business. They are, but and they've become more like when I first started in the business, those questions were never even asked, but now they are. But they're not taken into account as much as the critical illness. And I'm not the person who makes the decision at the life insurance company. So, that's not my area of expertise. But different companies, some of them will ask, some of them won't.
Okay.
But in your own health, and the other thing, I'm just going to interject here as well.
Yeah, no, please.
The other thing is on the term insurance policy, oftentimes people get it because it's inexpensive, but you can also convert it to something more permanent when your budget allows for it. Okay. So when you buy a term insurance policy, it'll say on there 10-year term, and it's renewable, which means it'll renew every 10 years, but it's also convertible, which means you can convert all of it or a portion of it to a permanent policy. So but what the life insurance company says, we don't care if you've got a $500,000 policy, we're at risk for 500 grand, right? We don't care if it's permanent or whole or term insurance. We don't care. We're already at risk for 500,000. So we don't care if you turn it in from a term insurance policy to a permanent policy. But they don't care because they're already at risk.
Okay.
Thing to know up front that opportunity is there at time of purchase, so that you can have a renewable. It's not just a straight term and at 10 years your rate goes up again, but it's renewable at that time and you have that option.
Right. So again, it reminds me of a lease. So now we're moving into corporate, but when you get a commercial lease and they're saying, okay, you're going to invest all of this time and energy into building the space. We're going to give you the option of renewing in 5 years, so you don't have to move. You can just stay in that space. So when you get the option, does any of the asset carry over from term, or no? Then the asset only starts building once you've turned it over.
Yeah, because there is no value.
Okay,
right?
gotcha.
And the whole life permanent, that premium will begin at that later age.
Okay.
So say you convert 5 years into your term insurance policy, your premium on the whole life plan now begins at that year that you're taking the policy now.
Okay.
You're basically buying a new policy because they don't have to worry about health anymore. That was dealt with 5 years ago.
Yeah.
And you just have to now pay the higher premium, and now you're building equity in your whole life plan.
Okay. And so what if you haven't invested in life insurance, and now you start investing in life insurance, but now, so Michelle uses this example of having, I think it's arthritis she's talking about, although the doctors are saying it's not life-threatening.
Yeah. Good question, by the way.
So what happens in that situation?
So there's what the life insurance companies will look at when they're looking at it. When you do an application, they do an application and they say, when I do an illustration for somebody, and again, we'll keep it simple. I'm going to do a $500,000 10-year term insurance policy. The premium is going to be $50 a month for a 37-year-old female non-smoker. I'm using arbitrary numbers. If there's 4 different things that they'll look at. Is this person that healthy that they actually will pay less than $50 a month? Like this one over here, okay? Not this one over here. When I did a policy for her, she was given a premium rating, okay? Then there's the standard rating. You're in relatively good health, okay? You don't smoke. You're not outside of the build. You don't have rheumatoid arthritis. You don't have diabetes and things like that. The next thing that they will do is they can rate you, okay? So instead of paying $50 a month for a 37-year-old non-smoker, they might look at somebody with, say, rheumatoid arthritis and say, you know what, that person is really 47 years old, and we need to price the policy based on a 47-year-old female non-smoker. Does that make sense?
Yes.
So they rate them. They make them older because it's a shortened life expectancy.
Gotcha.
Okay. And Michelle, don't take my medical expertise as the rule of law here. The other thing that they'll do is they'll decline. Okay, they'll flat out decline. I've had a number of those in my career, obviously. But there is also insurance policies that you can get. You see them advertised on CT or on TV. CPP is one. A lot of the insurance companies will offer non-medical. You sometimes have to say, well, yeah, I don't smoke, I don't drink. Okay, that's fine. And then the only question will be, have you had anything in the last 2 years? So you may have had cancer 3 years ago, and if you haven't had a change to your meds or anything in that time, you're good to go. And then you have insurance in place. Within the first 2 years, if you passed away, they would give you your premium back to your beneficiary. And then after that, you're fully covered. Okay. But those are very expensive policies. And the reason is because you've got a group of unhealthy people that are buying that. So out of that pool, right, you have to pull more money out of that pool. I hope that answered the question.
Okay. We'll let Michelle weigh in. Go ahead, Laurie.
You pay a little bit more, but at least you know that option is still there for you. So that's what I say to people, like, don't just say, oh, insurance is going to be too expensive. Get a policy written and find out, and then go from there. So
sorry, Laurie, and I've also helped build policies. And so I'll give you an example. I had a young fella who was diagnosed with leukemia at 19. And he went through, and he was playing junior hockey, and he had some issues, right? Well, obviously he had leukemia, and it's like, there's no chance you're going to get life insurance. Well, I went to PPI, and they have a special underwriting department that in that particular case, they went and shopped the market for me, and they were able to put a policy together for this young guy. Wow. 10 years after, though. It was 10 years after his leukemia. And oftentimes they'll say things like that. Like, I've had some health issues where they'll say you have to be free and clear of that health issue for a number of years.
Right.
And then we can go back. It's not automatic. They're not going to drop my premium automatic. I can go back and apply to see how my health is. So I have to go through all the medical again with them.
Okay.
Okay.
Yep, absolutely.
A lot of different scenarios.
Absolutely. So when we talk about life insurance, what is that primarily covering?
Well, yeah, go ahead.
That's a broad question.
Okay.
I can simplify it. Your life.
But I'm trying to figure out, so when we go, and so if we're approaching this to start off with, obviously kind of the first thing is you're thinking, okay, well, if something should happen and I'm incapacitated and I can't make money and I die, right? The life insurance is there. It's funds that allow my children or dependents to be able to sustain their life, right? The expenses are covered for them. Their day-to-day expenses, funeral expenses.
Let me try and explain it this way. If I'm sitting down with a typical family, we do what we call a capital needs analysis. In other words, what we're doing is we're looking at, what do you got? If you pass away, what do you have? You passed away last night, okay? What do you have for assets to use? What do you have for debt? What would you like to have happen? And where's the money coming from? Okay, that's basically what we look at. And
okay,
so,
can I just stop you right there, just so I'm clear on that? So everybody in the matrix, we've got our net worth, we understand our assets, we understand our debt. Some of these assets, like property, they might not want to have to sell it, right? Because they want people to be able to live in that house. So
RRSPs.
RRSPs, okay. So what would you be willing to let go of and liquidate if you needed to? And obviously you want to get rid of that debt, well, especially credit debt, obviously cars and different things, maybe they take on payments.
Cars, credit cards, mortgages, things like that.
Right, okay, so that's what you're saying, capital needs, let's take a look at all of that. What do you want to hold on to? What are you willing to let go of? And then what's the balance? Okay, I'm with you.
Right, so now let's say you have, after that, let's say you have, and you may have a group insurance plan at work.
Okay.
And let's say after that, you've got $200,000 left over. You died last night, there's no changing it, right? There's no going back. You got 200,000. That's what happens. Unfortunately, that's the way my world works.
Oh, we'll do another interview. I'm sure there's someone that can fix that. But okay, okay.
I got her with that one too. She says, well, this is what I would do. I said, no, you're dead. And she goes, well, no, no, you're dead. Be quiet.
But you know, it was bigger than that, because like I was telling you, Tanya, I would just want to know, how does Rob work with clients so he can work with me first and I can be his guinea pig. And he put everything on my whiteboard about me, my business, my life, and I own a building with a partner. Right. So he goes something about, well, so if that person died, do you want to be their wife's partner? And I go, no. And I started talking, and he goes like this to me: you're dead. You can't be saying anything. So even me as a financial advisor, because I focus more on the money side and, you know, that type of stuff, wealth and prosperity side, Rob is more on that side of it. I hadn't even clicked in on that. And I'm going, holy cow, you guys each need to buy a policy so that in this partnership or this corporation, if he passed away, then his life insurance would pay his wife. If I passed away, the life insurance would pay my boys, and the company, the corporation, pays for it. So it's a tax deduction. So I'm going, that was a lesson for me as a business owner.
Tax deduction. However,
Oh, it's not.
not in this case. However, what she's, we got a little sidetracked there.
Mm-hmm.
But what happened there is that in that particular situation, one of the most important things that they should have had was a shareholders agreement. Okay, if they had two people owning a corporation 50-50 with no shareholders agreement, they needed that. The shareholders agreement needed to discuss things like death. And if we're buying life insurance, we're adding assets into that corporation. Does that blow up, or does it increase the size of the asset to split in half? So again, the shareholders agreement should say, no, that is just used for funding, right? And the money can come into the corporation tax-free. And in that case, it creates what's called a capital dividend account. It can go out of the corporation tax-free to satisfy the shareholders agreement, which is, as she said, if he passed away, it pays off his wife. And now Laurie owns the corporation free and clear, and that lady receives her funds free and clear with no tax implications at all. It ought to be structured properly.
Okay, so definitely what I'm hearing is obviously it's important to understand with these incorporated businesses, what's happening, ownership, looking at it as a separate asset in terms of your entire net worth over here on your personal side.
But if it's not, and I hate to interrupt you, Tanya, but if it's not mentioned in there, let's say it's $1 million policy and you don't mention that in your shareholders agreement, that $1 million goes into the corporation, okay? And now instead of, let's say your corporation was only worth $1 million prior to that, now your corporation's worth $2 million, right? And now you got to send that other person $1 million where you really should have been only sending them $500,000, because that $1 million that you received as life insurance should not have been used to add value to the corporation, but it has to say so in the shareholders agreement. I know it's a little complicated.
Ooh, okay, but it sounds, can you not just define the beneficiary? Because it sounds like what you're saying there.
The corporation is the beneficiary.
Right, but is that just by default, or is that because I've set that up?
You structure it that way. Because if the corporation is paying the premiums, and somebody else benefits from it, then it becomes a taxable benefit.
Okay.
You have to avoid that. So the way to avoid that is by making the corporation the owner, the payer, and the beneficiary. And if you have a shareholders agreement that says, now that money is in the corporation, here's what happens to that money. And everybody's already satisfied because it was handled ahead of time.
Okay, and so this is obviously, now we're speaking to all the entrepreneurs in the group that have a business, but then it's obviously, it sounds like it's essential then at that point to understand that here's how those funds then get paid out to my family.
Correct.
Outside of the business, because that's the whole reason why you're setting it up, right?
And this is where you need your accountant, you need your lawyer, because the accountant understands capital dividend account. The lawyers understand the shareholder agreement. And that's where you have to have that conversation and bring everybody into the fold and make sure that when you're setting that up, that shareholders agreement says that perfectly, like through PPI. That's one of the services that we will offer.
Okay.
We will look at your shareholder. You may have an existing shareholders agreement that was written 10 years ago, and we will send that in, and their legal team will look at the shareholders agreement and look for any problems that may arise, that could arise. And it's interesting. I saw examples of national accounting firms written shareholder agreements that contradicted themselves on page 2 to page 11. They contradicted themselves. And so they will look at that because that's our area of expertise, not me, but the lawyer that works, the lawyer and the team there out of Toronto, and they will look at that for us, and it doesn't cost the client time to look at a shareholders agreement. They'll oftentimes find those. It's huge. But
partnerships agreements to start off with, let alone these layers, right?
Absolutely. I'm going to get back to one thing though that you asked me, and we didn't finish answering. Okay. When we remember we talked about doing the needs analysis, and there was a couple $100,000 left over, right? And okay, and if that person died, and now you're significant other, and you may have a couple of children, and is that enough to live on for the rest of, let's say, to get those children to adulthood or through school?
Yeah.
Right. And If the answer is no, and chances are the answer will be no, because 200,000, while it may seem a lot, it's not going to be a lot to help feed, raise a couple of, children that are 10 and 8 years old to 25 years old when they're done university, as an example. So you might, okay, we're going to buy life insurance. So we buy, again, let's say it's $1 million, and we buy $1 million worth of life insurance, and it's term insurance. And unfortunately, it gets paid out. Well, that money comes in, typically comes in one check, tax-free, to the beneficiary. What they do with that money is their business.
Okay.
That's it. Now, that's where you need your financial planning. And there's all kinds of areas, trusts and all kinds of things you can get into, what we should do with that money. But that's more of an individual case, like an individual scenario where you might have a situation where you've got children. Like, for example, my children, I have one of my children, the money is going into trust for them. The other two are fine, everything would go out. But in my case, and I named a trustee to look after it until such time as that, and oftentimes you'll have people with disabled children. And, we could set up a separate type of trust that Canada Revenue doesn't view as income that will pull away from their disability benefits. So there's all kinds of individual scenarios that you look at when you're doing your life insurance.
Okay. Now, it does get confusing, and I know I'm jumping ahead here, but I think this is a good place to bring this in. So when we're thinking about all the complexities and we're saying, okay, the accountant will help with this, an estate planner might do this, you've got some tax implications here, you've got trust funds to set up. Is there one person that can do all of this, or do you really need, no? Okay. So who?
I didn't mean to beat around the bush.
No, that's good. At the same time. Yeah. Okay.
There can be one person that can become what's called a quarterback, because often in a lot of the training that we do, you look at a triad and you go, the most trusted advisor for the majority of people is their accountant. Okay. And they're right here. There's your lawyer, there's your financial advisor. But really your financial advisor, that person becomes a quarterback for the whole thing, because often, like a CDA account, what the heck is that? A shareholders agreement, what the heck is that? Yeah. And this person, like, I'm kind of going to brag about Rob a little bit right now, because he's got a personality that is so...
Get back here, Rob. Get back here. Come back here.
So he teaches you. I've watched people walk out of this room with him explaining, drawing pictures of buckets and buckets leaking and stuff that is so real that they go, oh my gosh, nobody's ever explained our stuff like that. Yeah. So I say to a lot of people that may be listening, if you've got an existing policy, look at time to review. Yeah. It's time to review this.
That's a good question. How easy is it to change, maybe not policies, but how easy is it to change from one insurance coverage agent company to another company?
That's easy.
That's easy. Okay.
Yeah, that's just a change of advisor change.
Okay.
And that's nothing. Yeah. Where sometimes you find is that somebody might have a term insurance policy that they bought, and 10 years later they decided they're going to set up their own business. And a good life insurance advisor might look at that and say, maybe this policy should go into your corporation. Maybe it should go into your corp. And it used to be, Canada Revenue unfortunately closed that door about 4 years ago. But I did this with my corporation. I owned a policy on my ex-wife, and then what happened was I got it revalued, and I moved it into my corporation. And even though it was a term insurance policy, it actually brought value to my corporation. And so I was given some value to that corporation. It's a little bit complicated, but sometimes it makes sense to have a policy inside a corporation. Sometimes it doesn't. So again, it has to be looked at. But changing the ownership of the policy can be a little bit tricky depending on who's going to be the new owner. Because, for example, let's say I own a whole life policy or a universal life policy that has value and has grown and over the years, and then we decide, and we did this for Laurie referred a fellow over to me from Yorkton here, and he was selling his business, but he wasn't selling his corporation. He was selling his assets.
Okay.
But he owned two big life insurance policies within that corporation, and he wanted to keep them because the company owned them. If the people come along and buy his shares, they now bought those policies. So we had to get them out of there. So I had to go get them. I had to go get them valued. We have an evaluator out of Winnipeg that we use. We had to get them valued. So that dictated how much the tax implications were going to be to him when they came out. So and he knew what the tax implications were, but when he looked at it at the end of the day, it still brought a ton of value to his family, and that's what he wanted to protect.
Oh my gosh, so many layers of complexity. So I'm just thinking, if the company owns the policy, and that policy has become an asset, and then I'm dissolving the company, or I'm selling the company, and I want to buy that, then I actually have to buy the asset, right? I physically have to take
and what's its value? It's not just the cash surrender value, right? Because you may be unhealthy. And if you're unhealthy, okay, and then all of a sudden you have an actuarial evaluation of that policy, and all of a sudden now the value of that policy has gone extremely higher, right? So to pull that out becomes a bigger tax event. So you have to look at, is it worth it to me to do that or not?
Yeah.
Or do I just surrender the policy, take the cash surrender value and run? It really depends.
So
but oftentimes what happens is that you have individual people, they own their own corporation. And yeah, I've had clients put $50,000, $100,000 premiums into their life insurance policies, but strictly to protect them in case they died. It protected their family. But more importantly, you can shelter your trapped money inside your corporation. You can use your life insurance policy as a different asset class. Now think about that for a second. So you see these boxes we're working in? Do your people see these boxes?
They do.
Oh, good Lord.
Well, no, they don't see yours.
I'm going to comb my hair better.
They see.
No, that's why I asked.
He's a typical man. We're working in a box.
Okay. That's another. Let's say one of these boxes that you're looking at, and I do apologize, that we're looking at a rectangle right now. Let's say that encompasses all the assets that you have trapped in your corporation. Let's say it's $1 million, okay? And or $2 million or $5 million, and you've determined that I don't need all that to live. Right? Yes, I'm going to pull it out of when I retire. I'm going to pull that money out of my corporation as my retirement fund, whatever. But oftentimes you'll see people build big businesses or big, they have a lot of assets. They sell after taxes. They've got all that money trapped inside their corporation. They may have moved it from an operating company to a holding company, but in essence, it's still trapped in a corporate. What I mean by that, you go to pull $5 million out. Well, that's a $5 million income to you in that 1 year. You're going to get cream. So you feed it out to yourself over time. Or you might want to say, well, I still want to use some of that asset. I want to use some of that money, and I'm just going to change it from, say, cash to a life insurance policy. And let's say you take $1 million or $2 million of that asset and move that money into a life insurance policy. Everything inside there at that point in time becomes tax-free. So you've shifted it from a taxable position to a tax-free position.
Okay.
In essence,
so
it's
important,
a little more complicated, but it's pretty simple. So now you've taken a portion of your little box. Where's my camera? You've taken a portion of your assets and you've changed it from a taxable position to a tax-free position. And it can be done, but it's not for that person that's starting out their corporation. It's for the mature company that has built it over 20, 30 years, and they built that
value.
Exactly. Because when that money gets trapped inside your corporation, oftentimes people are cash poor and asset rich. And then when they sell, they got all this cash, but it's still trapped inside your corporation. And how do you get it? How do you remember I said earlier when we were talking before we started this, well, that helps you to create additional wealth and additional value to your estate on money you'll never spend.
Okay, so I see some questions coming in, and I just want to see, can we try to do a quick fire just so we get some of the basic questions answered for people, and then we'll come back to this. So when we are getting life insurance, whether it's term or whether it's whole, it sounds like there's a whole a la carte of what we can buy. We can buy insurance to cover our funeral expenses. We can buy the insurance to cover the living expenses of the beneficiaries, a lot of different ways that we can do that. When we're looking at critical illness, that's another a la carte. So if we feel that, we might be susceptible to some sort of illness out there, we would just check that. So it sounds like it's kind of a menu that we would go through saying, okay, here's what's important to me as a person, for my family. And now I'm hearing that I can buy it for myself and for my daughter. So in the event that something should happen to me, and whether I just get ill and sick and I'm not able to earn my living, that I've got coverage for myself and my daughter, or I can buy it for my daughter in the event that I pass, then funeral expenses are covered, her living expenses are covered.
Education, whatever.
Education. Can I also buy insurance on other people?
Yes.
Can I buy insurance even without their approval or knowing? Or no? Could I buy insurance on her father, for example?
Okay. As much as I'm enjoying this conversation, and I think you're a lovely lady, I can't buy life insurance on you.
Okay, good. Okay, that's what I was wondering.
The reason is there is, I need to have an insurable interest. Like I can buy.
Yeah, that sounds like it would be. I'm going to buy it on Jeff Bezos, and.
Yeah.
Okay.
Well,
Good.
actually, he's the one. Yeah, let him pay the premiums. But
okay.
Yeah, absolutely. Like, I own life insurance on my children. We have insurance on my granddaughter. Laurie has insurance on her grandkids. There's an insurable interest there. And if there's an insurable interest, you can. It's like a corporation buying insurance on you. That's a different entity buying insurance on
right.
Yes,
Keyman, right?
Yes, you can do that. And oftentimes, and I struggle with it at times, because when you're doing the typical husband and wife, you're buying it, they buy joint insurance lots. And it's sad when I see clients break up down the road. That's one tough thing to break up as a life insurance policy, because you need to value it at that point.
Okay, so that's a really important question that maybe we can just answer that. Do you buy two separate pieces of life insurance?
Again, because I'm old and I've been through a divorce. I've been through, you're 30 years in the business, you've seen a lot of things, right?
Yes.
And the people that, oh God, they were so in love and everything else. And then, 10 years later, they're pulling each other's hair out. But how do I split up a joint plan, right? Well, and if they're not talking, and I had that, a client, they were trying to get it was a joint plan. They were trying to get the insurance split, and the other person wouldn't sign the documents.
Okay.
Just out of spite. And so, it's going to cost you maybe $5 or $10 a month more each.
Yeah.
Okay. Or not each, sorry, because every policy has a policy fee or a policy, like it's usually like $120 a year to just to own the policy, typically. And so it's going to cost, $10 a month, $5 a month each more to have a separate policy. It's not a big price to pay, but it just gives you so much more flexibility. When you're selling to the lovely couple looking to, protect the lovely children, and having this conversation that when you divorce, but we sell lots of joint plans for sure.
Okay.
I have an example of that. When I was younger and we bought a home and went and got a mortgage at the bank, I go, I'm not buying insurance from the bank to insure my mortgage, because I'm protecting them, not me and my partner. So at the time we each went out, we bought our own separate life insurance policies so that if we passed away, that mortgage would be paid off. Guess what? That mortgage was paid off 25 years ago, and I still own the policy. So people are renting insurance from the bank. So there's that example, like Rob just said, had we bought it jointly, and we split up, we'd have to split the policy. We each bought our own, knowing that the money was to pay off the mortgage if something happened.
Yes.
But once the mortgage is paid off, this is our own life insurance to take forward. He's married now. He's got a wife. She's his beneficiary. I have my kids. So that is a perfect example, Rob.
Okay. Yeah. Okay. So who needs life insurance? Who would you recommend right now for people listening or watching this right now? Who should be investing in life insurance or renting life insurance, as you put it, Rob?
I would say if you have a mortgage.
Yep.
Because you've got some debt that you want to cover.
Okay.
I would just say everybody should look at their own situation. And 9 out of 10 people will probably require something. From my experience. No, they don't always buy it, but I mean 9 out of 10. And that could be the person that person that has tons of asset in their corporation. It could be the single mom that just bought a house It could be the couple that are, they're both employees. And, yeah, they have group insurance, but is it enough? But everybody should be looking at their stuff every so often.
Okay.
And you got
How
little
often,
kids.
you would mention that people are often looking at it maybe every 3 to 4 years. How often would you suggest they revisit their policies?
Again, ideally you should be looking at it once a year, but oftentimes
Beautiful.
things don't change that often. I'll
Right.
give a client a call once a year and say, hey, do you want to take a peek? They're like, no, we're good. And then, every couple of 3 years or so, we might have another conversation, sit down,
Okay.
just to review. Because,
Okay.
but I'll tell you, one thing is, when you have a big life event, you absolutely should be looking at that.
So big life events.
Absolutely. A divorce, a death in the family, a critical illness in the family, those kind of things, they trigger people to sit down and go, boy, we better start taking a peek at this stuff.
Can I ask, with COVID happening right now, is this a good time to be going out for life insurance, or is it a bad time because is it affecting policies or no?
Yeah, the only thing it's doing is it's slowing up underwriting, is because people are working from home. So I got a couple of cases in the mill right now that I'm trying to get settled, and the insurance companies, but they're also being more lenient. Okay, so for example, if I sold a $500,000 or more, say $5,000 to $1 million policy, I'd have to get the paramedical nurse to come in. They prick the finger for blood. They do a urine dip. They do height, weight, blood pressure, and then they ask a ton of questions. Well, those paramedicals aren't going up. They're not happening right now. So they're doing telephone interviews, but they've also extended it and say, well, now you get up to $1 million before we have to bring in a paramed. And if we need to get a paramed done, we can find a paramed company that'll do it, but they're not all willing to do it.
Gotcha.
So
Okay.
COVID it just did. That's all it's done. Those restrictions will loosen up, like going to the dentist.
Okay. So if I'm approaching this to start off with, I figure out how much I need, which is really kind of based on, I want it to pay out to cover expenses or to life expenses, how to 25 education. So that's what determines how much I need primarily.
Yeah. And then most of us have software programs that will say
that will do all of that.
It runs it through and it says, oh, you need $872,412 worth of life insurance. So,
okay. Yeah. And then the costs are going to fluctuate based on my health, based age. Yeah. Okay. So all of that, plus it sounds like also whether you're doing term or whether you're doing whole life, because one is also obviously you're building more of the asset and the cash surrender value as well, right? So you've got that going. And so we're saying basically almost everybody should take a look at life insurance. Is there anyone who doesn't need it that comes to mind for you?
I don't know. It's a tough one because we've never had a check sent back.
All right.
So I don't know. I don't know what to say because a lot of people need it. A lot of people want it. People want it for different reasons.
Okay. Well, and even young people, right? It's
it's
young.
Like,
it's
like young people. Exactly. Like I've got a young guy that's he's my youngest son, and he's building a house, and he's got a girlfriend, and they're and we're talking about getting a cohabitational agreement for him, and life insurance, and critical illness, all the stuff that you need. And he's like a 30-year-old kid going, and so, but
I know, there's a lot. I know there's a lot.
It's a lot for them to take on, and so try to walk them through it and in that. But as far as anybody who doesn't need it, I don't know. That's a tough one. I've had 75-year-olds come in I've had a 75-year-old female smoker that came in one time looking for life insurance, and I'm like, I'm sorry, sweetheart, your house is on fire. Like, it's a little tough to get when it's, I get it. But you know what I mean? Like,
that's the sensitive side of you coming through. I know.
Totally.
No, but you know what I mean? I said, but we did actually get her some life insurance for a short time, and it was very expensive, though. It was that insurance without the question. But she wanted it.
Right. So, yeah,
exactly. Final expense.
Final expenses.
Didn't want to leave any debt for the children.
Beautiful. Okay.
So when you say somebody that doesn't need it, this is what I'm thinking. Okay, a young male goes out, he buys a new truck, he's making quite a bit of money, he doesn't really have any responsibility as far as family or anybody to leave the money to. That would be some of the kind of people that might go, I don't need that. And even on his truck loan, what did he do? He bought life insurance on that loan, but from a car dealership or from a bank. So Bob's right. There's not a soul that doesn't need it. It's just that people aren't buying it, not even really realizing that they're buying it, and they're buying it through car dealerships and
Yikes.
like
Okay. So quick question for you. Is it best to bundle all these forms of insurance through one provider, or is it best to diversify?
It depends on what you mean by bundle. And I think, if I'm not mistaken, you're talking about car, house, life.
Yeah.
Okay, so no, and the reason I say no is because the life insurance companies don't offer like the P&C insurance.
Property.
They don't
Okay.
offer that.
Gotcha.
So for example, I used to be a partner in a firm, and we had property and casualty, we had automobile, and then we had a financial services side, right? And
Gotcha.
I owned the whole part of it with all of it, but it's never bundled. Now we would talk to our clients about both.
Okay.
We would talk to them, but you don't bundle it as a package.
Good to know.
home and auto, just for an example though, so people understand, you can buy a home policy and then buy an auto policy and get a discount because you bought a second policy with
Right.
the same company. That used to be a way when I ran my general insurance agency, that was a way to get more business.
Yeah.
And people were happy with that. And then if they had a claim, they only had one deductible. They didn't have a deductible on their home and a deductible on their auto if your vehicle got stolen and you had a bunch of stuff in it. So not bundling there, but the bundling that Rob is.
You can bundle, like there's one of the companies I work with, and if they buy life and critical illness and disability, they will consider that multi-coverage. They'll give you some discounts. It's not worth, traveling across the country for.
Okay.
But it is something that we can look at, and if it is a deal, we'll certainly look at it for clients.
Okay.
There's another policy out there, for example, that basically I describe it as you're buying a bag of money, and you're buying life insurance, critical illness, and disability all in one. Really good for that, again, stay-at-home partner, because disability oftentimes is based on income. Most times it is, but this policy is not. There's certain criteria you have to meet to get the policy, but it's very, very limited, very basic, and you're basically buying a bag of money. So if you buy a $500,000 policy, it covers you for $125,000 of critical illness. If that pays out, policy ends. If it's $500,000 of life insurance and that pays out, policy ends. If it's disability and you have $2,500 a month of disability and it pays out for, I believe, 100 months, policy ends. So, or if it only paid out for 10 months, then you have that much less life insurance, that much less critical illness. So you're pulling from the bag of money regardless of what you need. But again, that's one of those hybrid policies we talk about.
Wow. So there's so much. It reminds me of, okay, well, let's just talk about investing.
Yeah, exactly. What should I invest in?
So one thing that I think is on a lot of people's minds, especially when we start talking about insurance, is the fine print, right? And it always feels like there's loopholes all over the place. What do we need most aware of to make sure that it
Laurie and I talked about that over coffee this morning. And I said the fine print. I'm like, oh shit, I don't read the fine print. I had assistance for that. No, I'm teasing. Let me explain it this way. With life insurance, it has the least amount of fine print in it. Okay, 97% of life insurance claims get paid out. All right, you're buying life insurance. What they've done, they've already peeked under the hood. They know what you got there. Okay, that's during the underwriting process. Okay, they already lifted the hood. They checked the oil. They made sure the pistons are running and all that kind of stuff. They had their snapshot at that time. Once that's in place, it's a contract. Right? Once the contract is in place, it becomes a unilateral contract. You own it. They have no say in it as long as you pay the premium. Okay? They have their chance during that underwriting, the time you apply and the time it's issued. Okay? That contract's in place. Then you become a smoker. Too bad. They already had their chance. You become unhealthy. You get cancer. Nothing changes. It's a contract. Okay? And it pays out. So there's very little fine print in a policy. 97% of the time it gets paid out. When doesn't it? If you're driving drunk, you're in the act of a criminal, they're not going to pay out. They'll pay the premiums back, but they're not going to pay out. We had one up in northern Manitoba where a guy was driving a sled through the ice, didn't pay out. He was over the limit. There's the odd, rare situation.
So he didn't pay out because he had been drinking, not because he went through the ice.
No. If he went through the ice, no problem, right? But because he'd been drinking, right? He's DUI. You get the odd murder, the odd one is fraud. The fine print is very, very minimal in life insurance. Where you get into more of the fine print, the three policies that I typically sell is life insurance, critical illness, and disability insurance. And as you go down, it gets grayer and grayer. Now, I'm not trying to be because I've claimed for disability insurance. So, and I'll give you a really good example in a second about critical illness and disability, but critical illness insurance. Well, if there's 25 to 28 illnesses listed in there that they consider critical, right? But the definition of each one of those for each life insurance policy has been deciphered through each of their lawyers. Hello, right? And their doctors. So, I'll give a good example, skin cancer. You might have a claim on skin cancer with one company and it's only so deep in the skin, but they consider that a payout, a claim. Another company might say, no, we don't. It has to be so far into the skin. However, they're not as stringent on strokes. You know what I mean? So you're going to get into now, if you're buying a life or a critical illness policy, you don't have any of those issues. You only zoom in on the fine print if that becomes your issue.
Right.
Right. So it's really a difficult one to say, I really feel I'm going to have a stroke someday, so I really want to get with a lenient stroke company. Well, that doesn't work. You can't do that. But they do have that area, and it's not for them to get out of it. They have to have some sort of definition. You can't say I woke up with a headache. Well, I'm making a stroke claim. That doesn't work, right? There has to be some criteria.
Right.
Disability insurance becomes even grayer for a lot of people because you have to satisfy the definition of disability in your contract. And there's often different disabilities. Again, I don't want to go into the detail of it, but that's where you need to understand the fine print. Now, I know a lot of folks go, well, they just do that so they can get out of paying it. Well, no, that's nonsense. What it is that when you buy the contract, you have to understand the definition of a disability. Okay. Does it pay out if I'm a doctor, right? And I can't be a doctor anymore, but you could go pump gas, right? Well, I can pump gas. Well, now is my disability going to be cut off? Well, depending on the definition of disability in your contract. That's an extreme example, of course. And the insurance companies don't push you to that extreme, but they will push you to say, I had a client one time where they had a skin condition and they were a chef. Okay, so clearly they couldn't be, they weren't able to do their job. They were covered. But that definition only lasted for 2 years. 2 years and a day, the definition said, you can't do any job, we'll cover you. Well, they could be a hostess, they could be all kinds of things. So that's where the fine print comes in, right? But it's called the fine print, but it's just the contract. Now, the upside to this, I had a client who had a brain tumor that was cancerous. So he had 2 claims, really. You only get paid once on and he had a critical illness policy. And I walked a check down to his office and put it on his desk. And in 3 weeks after we made the claim, then he started collecting disability. He said, I got a check for something. And so I called the company and I said, what are you doing? They said, well, we're paying him for his disability. I said, well, he's still working. We didn't make a claim. And they're going, he meets the contract of what a disabled person would be. Gotcha. So then he started collecting tax-free disability as well, because he fit within the contract. Wow. Does that help?
Yeah, well, yes and no. What I'm hearing is that there's so much to this. And,
that's why I'm here so late. I had to go to school so long.
All of this information, and what's boggling my mind is we've spent an hour and I suspect we've barely scratched the tip of the iceberg. And the majority of people I know spend maybe 15 minutes with their advisor every 3 years. Right?
Because like if and we're talking about, I have to talk about a variety of different scenarios.
Yeah.
Okay. But those people have their one scenario. So when I sit down with them, I don't go through, if it's mom and dad and a couple of kids and they're both employees, we don't have a discussion about owning the corporation and the partnership and the shareholders agreement. That's not an issue. When you're having a conversation like this, we're talking in general, right? And
yes,
so
I get that, but
we focus in. When we sit down as an advisor, I sit down with an empty scratch pad and I just start asking them questions. I basically starts with, who the heck are you? Right?
Yeah.
And so that's the thing. When you're getting into those situations where you're getting into that estate planning and the like business succession planning you know, when to do an estate freeze and use life insurance and blah, 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 all that kind of stuff, you really need to get to somebody that's has some experience in in our line of work. That's where the CLU came in, is that it just takes you to that extra mile of understanding, you know, those kind of things. And plus, in our line of work, we go to constantly, we're at meetings and conferences and having these, you know, scenarios that
Right.
and we get tons of good support too from our legal and accounting teams with companies like BPI, from the insurance companies. If we're in a pickle, I can pick up a phone and get in touch with an expert. And yeah,
So I think what we'll do, I'm going to wrap up with one question at the end, which is like, where do we guide everybody now? You know, like what should they be doing? Like what's one good step for them? Before I get to that question though, one question came in over the Q&A about pensions. And when you've accumulated funds in pensions, and let's just say you're not working for that company anymore, and that fund is now it's up to you to do with it what you wish to do. Can you go and put that into an insurance policy? Can you take a lump sum and apply that policy?
No, because those funds are registered. Okay. So they're registered very similar to an RRSP. And I'm assuming we're talking about a defined contribution plan where they're not getting that monthly amount, they're getting that lump sum. What do I do with it, right? So they need to find an advisor and help them out.
Right.
Okay?
So, sorry,
So, no,
just on that point, for the question, there's the defined contribution or defined benefit.
Yeah.
The difference means one, you can do something with it. The other one is locked in, right?
Well, if you listen to the title of those two, one defines what your benefit's going to be. The other one defines what your contributions are going to be.
Right.
And the defined contribution leaves you with a pot of cash at the end of the day. But the reality is it's still locked up just like an RRSP.
Gotcha.
So if you take that money and you put that money into a life insurance policy, you have to deregister it first. That means, that well put.
Yeah.
Yeah, you're going to get hammered on the tax side, so it's not an issue. However, there are some strategies depending on age and when you do that, where you could say, you know, I'm going to use some of this pension fund towards funding a life insurance policy and that kind of stuff, and you know, that kind of thing. There are some things that you can do, but typically not.
It's a bucket. Keep that bucket over there. Yep.
If you're taking $4,000 a month out of your pension and of your defined contribution, and you say, I want to buy life insurance as well, then you can be doing that monthly, right? You're just not getting those lumps in there.
Yeah. Okay. So my final two questions then. Let's say people are listening to this and they've never put money towards a policy. They have no life insurance and they're going, okay, where do I start? What would you suggest in terms of finding an advisor? Where do you go? What do you do? What questions? What's the most important question to ask?
Well, I think, it's a tough one. Like, for example, like if somebody came to Laurie, okay, and you know they've heard that she does investment advising, and that's usually how they start, right? Because they want to do the sexy stuff. Remember we talked about that earlier. I'm sure this got sexier as we went along, and so you know, they go to Laurie, and then she can kind of identify these people need to have an assessment of, like she said, her number 6 in her discovery process, that you need to have somebody talk to them about risk management, and then they'll send them over to me. But oftentimes, like when I was in business, you know, in my other life, I did both. So we did financial planning, estate planning, life insurance planning, investment planning. You know, we did all of that within our firm. So people could come to a firm like what we had, and everything would be under that umbrella, very similar to what Laurie has here now.
Gotcha. Okay. And
but they should have, you know, and the one thing that I caution clients, and you know, you don't know because you don't know what you don't know, right? And so you want to stay away, in my opinion, you want to stay away from those ones that are selling the cookie cutter. Yeah. You know, they're selling the same insurance policy to everybody.
This sounds like anything but cookie cutter. The more you
well, that's what I'm getting at, is that you do a needs analysis. You look at what's important to them. What's their budget? What are their plans? What are their goals? You know, like, and I'll often say to Laurie, you know, I've looked at this situation and I think we should go this way. What do you think? And then she'll say, yeah, I agree. I want them to have more money over here, but we'll just do a term plan for now with the convertibility.
Okay.
You know, that kind of stuff. So, you know, you want to have you know, and obviously word of mouth, reputation, people typically know somebody.
Yeah.
Is compensation structure important? I know oftentimes when people are looking at advisors, it's like, well, fee-based versus commissions. Is that what happens in the insurance?
Life insurance, we don't have that in life insurance. We don't have fee-based.
Okay.
Okay. So we're compensated by whatever the premium is. The life insurance companies compensate us as part of that.
Okay.
Like as part of their premium, and it's not broken down. It's not like in the investment business where it's more broken down. In our business, it's here's the premium for that policy, and then like I used to say, I don't care what the compensation is, because as long as you're getting looked after, I'm going to get looked after too. Like we're not in this for we love helping people out, but yeah, of course we're it's a business too, but it doesn't guide our decisions. And I can easily sit here and say that, but how do you know?
Right.
I don't think my nose grew any longer, but I don't think it could. But but what I'm getting at is that it's that compensation. Yeah, it becomes a big question, but in the life insurance business, it's just not. It's just not there.
Not there. And so, for those that are listening in, then that have life insurance and potentially have a broker, but don't necessarily feel like they have a relationship with that person. That is, they're just paying premium over premium and aren't checking in. Any words of advice for those people?
Often, and you know what, Tanya, often in my practice, we've had clients. I remember, Laurie, you and I had one about 6 months ago. We were trying to track down who the advisor was. Well, the guy's been retired for 5 years. Like that happens. People move away. They move from BC to Manitoba, mostly Manitoba to BC, and then all of a sudden, my advisor and the other thing is you start to get into provincial regulations, because each life insurance is rules come provincially. They're not federal rules. Like they're federally. The insurance companies are federally regulated. However, the insurance business isn't. Pardon me. It's all done within each province. And so, for example, I'm licensed in Manitoba, Saskatchewan, but I can't sell a policy to somebody sitting in Ontario or Alberta, unless they happen to be in the province. And they're starting to get stickier on the rules about even servicing those particular policies. And so I advise clients, like, if they move out of our region, find an advisor. And if you don't know one, I probably bumped into one in 30 years down the road, and I can help you find one.
Beautiful. Oh my goodness, guys, that was just so brilliant. I still see questions coming in here. While I look at these questions, is there a question I didn't ask, an important question that you feel that you need to?
There was one, because you have a lot of entrepreneurs, there's a critical illness available through one of the companies that we work with. And oh God, without a whiteboard, it's hard for me to explain, but I'll do my best. The premiums are paid into a critical illness policy, okay? And oftentimes people would use this as sort of a backup to their retirement plan. So, example, let's say somebody is going to put $20,000 a year into premiums into a critical illness policy. Let's say the critical illness will provide $500,000 of critical illness, okay? The policy is owned by the company. The beneficiary is the company, okay? So the company pays $20,000 and it goes into the critical illness part of it, okay? But there's also a return of premium after 15 years, 100% return of premium, okay? So think about it this way. I'm 45 years old. I've got big cash flow coming into my corporation. I want to make sure, I'm the key person, I want to make sure that my business doesn't suffer if I become critically ill. Like I was at a conference in Winnipeg a year ago, and there was a young guy there that bought this stuff, and his business would have been flat had he not have had critical illness insurance. But let me just finish though. So what happens is that the $20,000 is paid to the insurance company that provides the critical illness to the company, tax-free. Okay. Now, to get that $500,000 out, let's say he wants to use that money personally, he has to pull that money out. Well, that's fine. At least it's there. However, let's say they don't use the critical illness. It was there as insurance, right? But let's say that insurance didn't get used. And now that $20,000 after 15 years, what are we talking here? $300,000, okay? And he cancels the policy. He or she cancels the policy, okay? The return of premium portion of the premium has been paid by the shareholder, the owner, personally. So when they surrender the policy, That 300,000 goes directly to the client tax-free.
Wow.
Yeah.
To the owner of the
To
share.
the owner of the share, tax-free. Okay? And all you need to do is the portion that's return of premium, that part of the premium of the 20,000, let's say 7,000 of that policy is return of, you're paying for the return of the premium later.
Yep.
That gets dividended out by your accountant. Again, you have to have that conversation to the individual shareholder. So they get their money back out tax-free. So basically they've just pushed their money into the future and just used it as, and really if you stop and think about it, what paid for the insurance? Just the interest on that money.
Well, okay. Yeah.
Hard to explain without a whiteboard.
Wrapping my head around that one. I'm still confused as to why it's tax-free as a different.
Because again, picture the premium being split up. 13,000 pays for the risk to the insurance company for the 500,000.
Okay.
7,000 pays to be able to get your money back out later.
For return of premium.
For return of premium.
Okay.
So the individual has to pay that by them, like personally.
Yes.
So what will
So it's
seven?
after tax.
So the accountant will just dividend that out every year.
Okay. Okay.
So now, if the policy matures and they decide, okay, we're going to wrap this policy up, now the return of premium goes directly, because it's just a return of premium. There's no gain, so there's no tax, and so it goes directly to the shareholder personally.
Okay. Yeah.
And then the policy winds up. It's a great forced savings account, but it also gives you that protection all the while you're running a big business, and all of a sudden you become 5 years down the road, you get critically ill, cancer, obviously, heart attack, stroke, those kind of things. That money goes directly into the company. Use it to help pay wages. Use it to help run the company, hire somebody, do whatever you want with it.
Well,
So
I tell
one of
you,
the ones that I wanted to touch on because I know you had business clients and I want them to
those
think about
are
that one.
huge. There's so many people that are watching this that are entrepreneurs, and the more I get into this, it's funny. I mean, I've been doing this for 10 years, and I keep thinking that I'm getting wiser and wiser.
And then the old white hair guy comes along.
Yes, is not how it's going. But it's interesting because the vast majority of business owners, that I worked with, we never built a line item for pensions.
Oh
right?
my God. This one is, there's, like
life insurance, right?
We talked about protecting wealth, but I also talked about creating it.
Yeah.
And you can do that, but those are for those mature businesses that have good cash flow or big wealth within their corporate.
Well, yes, but I think also what I've noticed is when small businesses can take small steps at the beginning, it's not overwhelming. It's like, okay, I'll just do this and it just builds good habits, good practice, versus now my business is 500,000 or $1 million, and now I have to bring in this whole policy. Right? That becomes overwhelming and daunting versus just small little smidgens here and there, right? And small consistent steps. Well,
you think, like I have an accountant friend of mine. I explained this whole thing to him. He understood it inside and out, and he still didn't do it. And he was the perfect fit. I'm like,
what we resist persists.
I like to walk and talk the talk. You know what? If I'm going to suggest certain things to certain people, I'm going to make sure that I do that too.
Yeah.
It's like to simplify what Rob just said in a little different way. So my grandkids, like I find, kids have so much stuff. You buy them a critical illness policy, it's on them. Yeah. Grandma bought a critical illness policy. Well, grandma's a business owner too, but I buy them a policy. It protects them if they don't need the critical illness insurance, because who needs time off if a kid becomes critical ill but her mom or dad, and then in the future 20 years, that kid can take the money if it's not used and they can use it for education.
Huge,
or
right?
Whatever.
And it also had the same amount
of
of
the toys and all the garbage out there. And I get it. Well, you know what? I feel like, you could come back every week for the next year and we'd still be learning. Just, thank you so much. I know I'm going to close it here. I know there was a question just around if there's anybody that you can recommend in Saskatoon. I'll stop the recording. We can answer Michelle's question on there, on that piece specifically. But while we're still recording, I just, again, thank you so much, the two of you, Laurie and Rob. Like, it's just, it just blows my mind how much information is out there and how much we don't know, but with small little baby steps, right? Just taking control over our financial future and having the courage to ask advisors these questions, right? And brokers to say, you know, what are my policies? Where are they? Is it term? Is it whole? What are the differences? These are people that work for us to ensure our financial future and security, and not being afraid to ask those questions, right?
Yeah.
Right. So thank you again so much. And I hope maybe I can get you back in here again and we can go into a whole other rabbit hole down there. So I'm going to turn the recording off. Thank you everybody for watching. Appreciate you being here. We'll see you in here next week. So sorry. Okay.